Robschild, no investment advice. Welcome to the show where we view financial markets using Ben Graham's investment philosophy, macro, technicals, and crystal ball gazing in that order. Today is Wednesday, November 20th, 2024. Today's episode, NVIDIA earnings came out today. The quarterly revenue beating expectations at $35 billion, and the earnings per share also beating expectations, being at 81 cents versus the 75 cents expected. Well, Robschild, you were wrong. NVIDIA beat expectations. Its stock must be going way up. Let's take a look at the chart. Oh my goodness, it's down 1.5%, and earlier it was down as much as 4%, I saw at one point. Well, how the heck did that happen? Like I've been saying on the show for a while, when you have a, you can see it right here, PE ratio sitting around, it's 68 and a half. It means people have been paying $68.49 for $1 of earnings. That's a very expensive price. A normal company, valuation is around 20. And so, once we have enough production of semiconductors meeting demand or even exceeding demand, you can expect companies like these to trade, very easily around a PE ratio of 20, which will happen in the future. Mark my words, NVIDIA will not maintain a PE ratio of 70 forever. It can't. Not with competition and not with any kind of valuation that makes any kind of sense. Again, it would have to triple its earnings for its current price to make sense. Is it tripling its earnings? Let's take a look at its earnings, its quarterly earnings from macrotrends.net. It doesn't have the current 81 cents, but it has the last quarterly view of it, 67 cents. So yeah, it went up from 67 cents to 81 cents, but that is not a 300% rise in earnings. That is a much smaller percentage of rise. And additionally, again, once you have more production coming from this company itself and from competitors, the revenue can even go down, because once you have competition of prices, people will be, picking whatever makes sense in the market. NVIDIA can't make these kinds of profits forever. Just like in the car industry, at one time people thought car companies were going to, make a lot more money than they would in the future. Today, as we stand right today, there are so many major car companies selling at very low PE ratios, around 10 or below 10 right now. Cars are great. Everybody uses them. Everybody needs them. And once you have enough production, the valuations of the companies don't stay at 70. They just don't. SMH in after hours is not showing as much of a drop yet, but the fact that we didn't get such a strong move to the upside from NVIDIA, it's saying pretty clearly that, Mr. Market here, this giant head and shoulders top I've been discussing pretty much every show, again, engulfing candles on every point of this, on each shoulder, and a double one in the head. And then a rising wedge cracking down, a head and shoulders cracking down, and remaining flat, slightly bearish. That means, today, if semiconductors were going to get a bid off of some kind of great news, it would have happened. It would be happening right now. We would see that. And so it's very clear to me. I'm even more confident than I was yesterday that semiconductors will continue lower. I took some profits today just in case I was wrong. It's always, no matter what, whenever you're making any kind of investment decision, you have to assume that you will be wrong, and will you be okay with being wrong if it goes against you? So my short position was already up by 25%, so I reduced it before the close today, but I'm holding onto, it's actually 5% of my portfolio short SMH with SOXS right now still. It's still obviously a speculative position, and at heart I'm a Ben Graham value guy. But this chart pattern combined with Ben Graham's, philosophy, the fact that this is just so obviously in a bubble, this is so obviously overvalued. Why not take advantage of the ride down if it looks like we're headed there? That's kind of my take on it. Again, if we get down to this neckline of this thing and break it to the downside, it can easily drop an enormous amount, and I'm not going to miss it. Next up on today's agenda, Fed cuts are not accelerating yet. As you probably recall, in September we had a 50 basis point cut. That was a very strong cut, and that almost already off the bat said that the Fed was thinking that they were already behind the behind the cuts, that they're already like catching up. And today, instead of accelerating, we're actually seeing an increasing chance of there being no cut. Again, this changes day to day, but we're basically 50-50 cut or no cut for the December meeting as it stands today anyway. I am looking out for signs of the Fed cuts accelerating, where we get to the point where the Fed funds futures are continuously like pricing in more deeper cuts. Instead, we're sort of like going the other way for a little while. We're not there yet. We're not at the point where there's emergency meetings and that kind of thing. We haven't had the Black Swan event yet. The Black Swan event actually might end up being a major stock market correction that kind of, is the driver of things rolling over. And of course, with that, job losses going up, job openings going down, bankruptcies all over the place, banks blowing up, and then the Fed's coming in and being like, oh, I got to turn on the money printer again, and here we go again. We're not there yet. I can literally smell it coming. I wanted to do today on the next item on the agenda just a slightly deeper dive on Walmart earnings. I mentioned yesterday on how Macro Trends had the PE ratio at 43 as the most previous reading of this, and it doesn't take long to do the math. If you take the previous earnings per share of 58 cents and add it to the last 3 quarters, you get a trailing 12-month EPS of $2.44. Divide the yesterday's price by that number, and you get the trailing 12-month PE ratio of 35.5. So that's not, that's a ways lower than 43, but it's still really expensive, especially for a company like Walmart. There's other ways to look at this too. By the way, a fair valuation would probably be around 20 PE ratio for this company, especially considering where bond yields are at above 4%. Another way to look at this is as well, that just adds to the case that yes, it's still in like bubble territory price though, is that you can take the earnings per share 10-year average, and that's $1.45, and so that's quite a bit lower than the current past 4 quarters, meaning that the past 10-year average would mean that the PE ratio would be a heck of a lot higher, which makes it look even more expensive. And by the way, this is all in the context of the fact that we haven't seen a full business cycle. Typically, from Ben Graham's book Security Analysis, the reason he says take the past 10 years and average the earnings to get a good picture as to, what might be a fair price. His method usually sometimes on one of his ways of calculating it anyway, is that you don't want to invest in something that has a PE ratio of more than 25 based on the average of the past 10 years of earnings, which is supposed to include a full business cycle. That means a recession. That means a part of the cycle where, things got rough and they had to dig us out of it. And we never went through that full business cycle. So this 10-year average is actually also extremely optimistic, adding more to the idea that the current price of Walmart is very excessive. So although they had a solid past 4 quarters, adding to this, their history does include a few quarters of negative earnings. This is another, red flag in Ben Graham's methodology. The fact that a company like this has to have negative earnings every once in a while. And if we get a slowdown and we have negative earnings while it's already overvalued, taking into account a very solid 4 quarters of earnings. So in other words, we're priced really high for the best possible scenario of where earnings are right now. We haven't even seen anything bad come yet, and it's already majorly too expensive. If we do see that contraction, then the amount that this can lose in price is just enormous. It can go down more than you think, a lot more than you think. Especially, companies like this, in really bad times when everybody's really scared of the stock market, a company like this could trade as low as maybe even a PE ratio of 7, believe it or not. So yeah, really, still just really scary stuff. I felt the need to go over Walmart again just because I mentioned the 35. The PE ratio being 43 instead of 35, but it doesn't change my base case that this is just a very, very, very dangerous price for Walmart specifically. Last thing on the main agenda today, Thursday, tomorrow, we have initial jobless claims coming out in the morning. This is one of those numbers that at any time, if we see this massive spike, that could be like the black swan that really sets things off. Nothing has changed in the daily reminders. To hear me walk through the daily reminders, watch Monday's show. For this week, that would be 11/18/2024. It's the yellowish looking one with a castle in the ball and snakes around it. And along with those daily reminders, the crystal ball ratings remain that the S&P 500 itself, besides Walmart, is currently priced like it's a Ponzi scheme, relying on other people to bid the price higher without the value to back it up. The crystal ball rating also suggests that a bear market is imminent and that the Fed won't cut fast enough to save the economy. And even if they do, the effects won't be strong or fast enough to save the economy. That was a bit redundant. You get the point. Moving on to the charts, the S&P 500 going flat. If anything, this sort of looks like a bear flag to me. The dollar has been getting very high, and today, yesterday I said this looks, like the kind of motion that's more of a bull flag than anything else, and today it looks like we're getting back into bullish mode. So hold on to your hats. The dollar going higher can really shake up the world economy. The 10-year break-even inflation rate ticking tiny bit to the upside today, but very notably going very, very flat for a while. There's certainly still a battle going on here in expectations of inflation moving forward. TNX, the 10-year Treasury yield. If you're watching this, I'm assuming that you've been watching my shows. You know about this purple line dating back to the top of 2021 and the giant head and shoulders top. We are still bumping our head on it. This is it for me. I really think rates are curling over here. I think we're going down here. I think that we're shaking out. I think the Treasury market is shaking out the rest of the weak hands for money to let's say, do well in longer duration treasuries here, especially, look, this NVIDIA earnings and revenue coming out, beating expectations and the market reaction being muted. It says that, I don't think this is enough to hold the market up, especially considering the high valuations that it has. And so I am expecting pretty decent correction at the very least in most of the U.S. equity market indices. And when that happens, you oftentimes get a rush into safety. And so I think that rates will drop, and I think they're going to drop pretty fast, actually, from here on the longer end of the curve. But that's just me and my crystal ball. I talked about this Head and Shoulders top looking so perfect, and today kind of wrecked it, right? We popped back up above the neckline. Some people might want to see a closing confirmation candle above higher to fully make this pattern worthless. But this move here means it certainly lost strength. Wood's getting a little bit of a bid here. Again, this is an ETF. This could have been like one company's earnings that were really good, that gave it a little pop to the upside. I'm not entirely sure. We had other housing data come out actually the past 2 days, and that didn't send Wood higher. So I'm not sure exactly what's going on here, but it's a good leading indicator to keep an eye on. I still think this pattern is likely to still play out to get down to 73, but I have less confidence about that today than I did yesterday. Last chart of the day, Bitcoin getting to all-time highs today, around $95,000. I still see a crypto winter, maybe the biggest crypto winter ever, coming very soon. But all-time highs in Bitcoin. I have no idea how high this will get, nor do I care that much, but it's always fun to watch. And that's all from me and my crystal ball. Hope you enjoyed. Thank you for watching, and see you next time. Robschild.